The investors here, Cliff, I'd like to share are self-selecting, high-caliber investors, institutional, multi-family office, single-family office, people who are interested to hear from Lena and from you. And I'd like to say we've just heard from Israel Sovereign Wealth Fund, and in 10 years' time, it looks like it's going to be a serious project. And in true Israel fashion, I think a blessing in 20 years' time will be for there to be arguments every week in the newspapers about how to use the capital that has been built up most effectively for the benefit of our people. So, now, Cliff, thank you for being up in the middle of the night. I know how much you want. Thank you. I know how much you wanted to be here in person. For many people here need no introduction to Cliff, but I'll share one anyway. AQR, $187 billion asset manager based out of Greenwich, Connecticut, founded in 1998 by Cliff and his partners, a team that Cliff put together, leaving University of Chicago and then Goldman Sachs. And Cliff will tell you more. AQR is possibly the largest quant investor in the world, so I'm sure AQR's AI is all the rage now, so I'm sure Cliff has something to say on that. And I really say, what can I say that encapsulates Cliff is that he's someone who lives with a complex contradiction that adds value, which is that he's an institution builder over this last nearly 30 years, but he also is known for standing outside of the crowd, for cutting through hype, for trying to dispel investment myths. And he doesn't just do that by going on interviews, but he has a very powerful research engine, his own research and the team's research, which they put a lot of investment into and publishing that research. So without further ado, because we're here to listen to you, Cliff, not me, question one. You were in Israel just now, so how did the trip go? Tell us about it, and I know how much you wanted to be here this morning.
Sure. Well, it was fabulous, the half of it that I completed. I've never fled a country before, so this was a new experience. I will tell you, it was very disappointing to have to go. We had things, I have things this week in New York that I absolutely can't miss, which is why we cut the trip short, which is why I'm this disembodied voice over Zoom instead of what I had intended, which was to be there in person. But we spent close to 5 days in Jerusalem and 1 day in Tel Aviv. It was supposed to be 5 and 5. I have to admit, I had not been to Israel before. I don't know how much personal biography you're okay with, but I
as much as you're free to give.
New York City Reformed Jew, which is really an argumentative form of Quaker. Hopefully people know I was kidding there. It's hard to tell over Zoom. But it's not even about Israel. I have never been practically anywhere that wasn't work till the last couple of years. Basically, if I visited your country, it was to ask you for money. Sometimes I visited to ask you not to take your money back, but it was mainly work. So I've just really started, I'm approaching 60 very, very shortly. So my wife and I have started traveling, and to be blunt, I'm somewhat of an October 7th Jew. I've certainly gotten more serious about it in every way, including Israel and supporting causes. And I had planned to go several times. One time in particular, we were weeks away from going, and then my mother got sick, and a lot of that plan was to take her. So it was high time. And did we make sure it happened now because it feels more important to visit now? Yeah, I think that's true. So I think it accomplished a lot for me. I got to see the place in person, to get the spirit of the people in person. Stuff I kind of knew, but it's not the same until you're on the ground. And frankly, had a lot of fun. I'm a history buff. when I'm not quanting, I'm reading something, some historical, either nonfiction or fiction. And you've probably noticed there's a fair amount of history in your country. So that was a lot of fun. And I don't know if you guys feel this way. You never know about how you feel about your home country, but it was some of the best food I ever had for 5 days. So great visit. I'm probably going to be back in May. I'm going to try to make it a more regular thing. I think it's important. And sorry I couldn't be there in person. Almost made it.
Thank you, Cliff. Yes, I think we are sorely deserving of Michelin stars in this country. Coming from British cuisine, it's a different world. Yeah.
Well, that's what we call a long-short strategy.
And we look forward to welcoming you on your next trip to Israel, and hopefully it will be both for holiday and, as you say, to ask for money. Could you share with us some background going back to the nascence of AQR, your PhD at University of Chicago? I've had people in this audience quoting your research to me, without any preparation. So we'd love to hear.
That's really cool and a little scary. But I got very lucky. And any time you get to a certain point, you're happy with it. If you don't admit you had good luck along the way, you're probably not telling the full truth. I decided I wanted to get a PhD in finance. How I came to that decision, I have to go too far back and I'll bore everyone. But I showed up at the University of Chicago in 1988. This was a very fertile time. The very beginnings, and the form has changed a lot. The models we use today barely resemble stuff we were doing in 1988. But the core kernel of what would come to be called quantitative investing, what would come to be called factor investing, was just starting in academia. And Chicago, particularly the work of Gene Fama and Ken French, was at least one, I would call it the epicenter. Certainly not the only place doing great work on it, but I would say it was the epicenter. And I showed up there just when it was getting started. And I got to work with Fama and French. I was Gene Fama's teaching assistant for a couple of years. A standard joke I make, and if I sent you a bio, it may be in that bio, is that working for Gene Fama, I still feel guilty every day when I wake up trying to beat the market. Because Gene Fama is known for many things, but probably most directly for the efficient market hypothesis. And one of the implications of that is it should be pretty hard to beat the market. I think the things we believe in are pretty similar to the things Gene believes in. So I don't think he'd yell at me too much. But I got there, and the state of what I'm going to call quantitative investing. Keep in mind, we did not have these terms back then: factor investing, quantitative investing. It's always funny when you talk about the past. You always use today's terms, but you weren't thinking of it that way. We were just trying to figure out why some stocks outperformed and some underperformed. And kind of the state of the art at that point can be summed up in today's language as the value factor and the size factor. Small firms tended to outperform large firms. We've written a lot about this, and we can get into it later if you'd like. We don't actually believe that one too much, but that was the state of the art back then. And the value factor: low multiples beat high multiples. Early papers, I don't even called it the value factor, and I happen to think that's a terrible name, because any competent active manager who's picking individual stocks, not a quant, someone really getting into the details, who would call themselves a value manager, is looking at a lot more than multiples. A low multiple might be justified, But we did find, and when I say we, I mean academia as a whole, we did find that even as an imperfect, simple way to express value, low multiples did tend to beat high multiples. I wrote my dissertation for Gene Fama on adding what I would say was the next big factor. And again, I got to be humble about it. I was not the only one looking at this. I think the first paper on this that I would say started, it was by two professors, Jagadish and Tipman, in like 91. They beat me by about 6 months. I still dwell on that occasionally, but my dissertation for Gene Fama was on the simplest strategy in the world, the price momentum strategy. Buy what's going up over the last year, sell what's going down over the last year. If you ever want to do something hard, tell Gene Fama in 1989 that you want to write a dissertation saying you can beat the market by just looking at the price today and the price a year ago. That's not a result that's really easy to reconcile with the efficient market hypothesis. To Gene's credit, when I told him I want to write this paper, he said, if it's in the data, write the paper. So he was, he was very pure about that kind of thing. I did not write a paper saying I found a better factor than Gene Fama. That would have been both untrue and poor graduation strategy. I did say that if one likes low multiples, they can outperform. But if one likes things that are heading up, they tend to keep heading up. And these two together worked considerably better than either one alone. I'm gonna be a quant for a second. Even they are negatively correlated strategies. If I'm buying what's cheap and selling what's expensive, even using simple methods, and you are buying what's heading up and selling what's going down, the evidence is if we both stick to our discipline and do it over the long term, we both seem to make money. But I think it's fairly intuitive that a particularly good period for momentum investors, usually not the best period for value investors, and vice versa. So I think it was the right investing conclusion, but it was also the right graduation strategy to frame what I did as a wonderful compliment to Fama and French's work. I then went to Goldman Sachs. I was enticed to go there for a year, to take a year off of academia. A professor of mine from undergraduate and my best friend were both working together at Goldman Sachs. I went there, I traded fixed income for about a year. When Goldman decided they wanted to start a quant team. Trading fixed income for a year and writing a dissertation at night on quantitative ways to choose individual equities was a very weird life. You know, Goldman Sachs is famous for, and I experienced this, massive work weeks especially back then. I think they've gotten a little kinder and gentler now. But so it was an intense period trying to write a dissertation while being a fixed income trader during the day. This is probably way too much detail, but many years later, my wife and I had 2 sets of twins, 18 months apart. That was the tied for the craziest period in my life. Right. Running AQR with 4 kids in diapers at home was about tied with 80-hour weeks at Goldman Sachs and writing a dissertation. Different nighttime activity. Right. When you're up at 2 a.m. typing on your keyboard, it's a little different than the children. But Goldman asked me to start this group. For the fellow old guys or old people in the audience, you might remember this. The reason they probably asked me to start this group was the then success of a firm called Long-Term Capital. Long-Term Capital was this marriage of academics with old school Solomon Brothers That's kind of old Wall Street fixed income traders. And they were doing very well. Now, again, the fellow mature people, I'll call them, I'll stop saying old, in the audience might recognize the irony that about 5 years after that, long-term capital had a celebrated blow up and went to zero. Luckily, they hired me to do for them what long-term capital was doing, but they had no idea what long-term capital was actually doing, nor did I. So we became a general quant team. And the first thing, and by the way, I'm not going to take this much time for every year in the story. You know, there are about 32 years left, so it would take a while. But the first thing they asked us to do was a macro question. I was writing a dissertation on choosing individual stocks. First thing they asked our new group to do was, can you help choose countries? Can you tell us which countries are more or less attractive? I think I probably said, sure, of course we can do that. And then went in a room with my 4-person team, and we all looked at each other and said, how are we going to do that? I'll give you the answer we had back then, which is still a similar answer to what we do today. Pretend the countries are individual stocks. A country, think of it, the whole stock market of a country has a valuation ratio. Whatever your favorite is, price to sales, cash flow, earnings, adjusted for industries or not, whatever your favorite valuation is, you can do it for the whole country. And price momentum is easy. You just look at the index. Luckily for us, again, luck rears its head, that held up for countries, similarly to individual equities. So I've now brought you to the state of the quantitative art circa 1994. About 3 years later, 1997, I decided to leave Goldman Sachs to start my own firm. Goldman was very kind to us. We had a great experience there, but we were also a very isolated unit. We weren't using anything that was particularly Goldman Sachs. We were buying data from the outside, building models. There's a separate story. A partner of mine named David Kabiller, who, this was actually funny. During one of my tours in Jerusalem, the guide said, do you work with David Kabiller? And he had the same guide like 3 months earlier. So small world. But he kind of talked me out of staying at Goldman. He talked me into leaving. Spent about a year working on me. So in 1998, we formed AQR, and we launched our first fund in August of 98. By that point, we were trading equities, not just in the US, but around the world. We were trading countries using futures. We were trading country bond markets using either futures or swaps, and we were trading currencies. In each case back then, it was value and momentum based. Now, you might be thinking for bonds and currencies, can't use what you use for equities. There's no price to earnings ratio, there's no price to sales. Simple things, and models were very simple back then. Ended up working fairly well. For bonds, real bond yield. What are you getting over inflation? For currencies, purchasing power parity. That's a wonderful one because people all through the currency world think that has no efficacy because they think of isolated examples like, you know, dollar yen has stayed misvalued forever or something like that. Turns out if you do it systematically across 20, 30 currencies, there is an edge to buying cheaper ones. Now I've taken you to our models circa 1997. Since then, they've gotten very different. The core of believing that things like value and momentum matter is still there. But how do you measure those two things? And adding more richness. Remember when I said the quants calling things the value factor is a bad name? That value is a more holistic concept? if you look at both academic finance and applied quantitative models like ours and other firms, a lot of the additions in the last close to 30 years have been making it a more complete investment process. So it's not just is the multiple low and is the price going up. It's are the fundamentals going up along with the price? How profitable is the company? How risky is the company using accounting measures or the famous quant geek measures like beta and volatility? Are they buying back shares or issuing shares? It's become a very rich model that I think it's still a quantitative approach, and that still is very different than choosing, a concentrated portfolio of individual stocks. But quantitative processes like ours, I think, look a lot more like traditional investing in a more deep, holistic way than they did in the past. Now, I'm going to stop and let you either tell me to keep going or ask another question.
Okay.
Because you may have noticed I will just keep going otherwise.
So there's two strong motifs there. You started with size and said you'll come back to it, and also talking a lot about value and momentum. So this brings me to a question that Lena Kropalnik actually asked on one of our conversations, and Lena could put it more intelligently than me, but with AI, doesn't that mean that everything you've built over the last decades, the scale, painstaking work and backtesting into 300 plus signals, can't some guy just pop up a quant fund, use a supercomputer next summer, and be able to compete in terms of the quality of what you're doing?
Yes, that's going to happen. Thank you. Have a nice day.
No, I've screwed up.
Well, stepping back, on a sufficiently long time horizon, the combination of AI and robotics has put us all out of a job. It is above my pay grade to figure out what the world will look like when everything can and is most efficiently done by those. But I will tell you, I've written about this. I had a piece just over a year ago called The Less Efficient Market Hypothesis, where this wasn't about AI, and I will link back to AI, but the argument in this piece, which is that markets in my career, call that about 30, 35 years, I believe have gotten a little less informationally efficient, not more. Now, it's easy to think technology always makes things better. If you spend a lot of time on social media, you probably are disabused of that notion already. But in some ways, technology has made markets more efficient in certain narrow ways. They respond faster. You can trade cheaper. But an efficient market in a Gene Fama sense is one in which prices are accurate. Even Gene doesn't believe markets are perfectly efficient, but in a perfectly efficient market, prices accurately reflect all available information. That is not an exercise that is greatly affected by trading going from 10 minutes to 10 nanoseconds. We've seen in 1999 and 2000, the famous dot-com bubble, and then in 2019 and 20, which we can call the COVID bubble, though, I said 2019, it was definitely starting before COVID, so I wouldn't just blame it on the pandemic. As we measure it, the two biggest dislocations within the stock market between the cheap and the expensive, we have seen over the last 100 years. Now, that is an odd fact to reconcile with the idea that technology just makes us better and smarter and things more efficient. If in the paper, I hypothesize, and I have to admit that this paper was in the Journal of Portfolio Management. It was their 50th anniversary, and they invited a bunch of the old guys to write on whatever they felt like. So it was a less quantitative than my normal papers, because it was a little more op-ed and opinion. But I had two main hypotheses for why I think these events have occurred. By the way, when I say have occurred, doesn't mean I can predict when they can occur, but why things have gone a little crazier live in my career than they did in 100 years of data. One, you've probably heard a million times, the growth of passive investing. I'm not a passive hater. There are people who passionately hate passive and think it's responsible for everything in the world. There are active managers who will blame any bad hour and a half they have on passive investing. I think passive investing is a wonderful tool, and I think the individual investor should be able to own the market at very low fees. But we know there's a paradox in passive investing. The whole world can't do it. If every single one of us tries to be passive, and here I mean like Vanguard, Jack Bogle, own the market proportional to the market cap. That means literally nobody is thinking about, do prices make sense? Nobody is saying, is Nvidia worth more or less than the corner drugstore? So we do know we need a certain number of active investors. In fact, you can think of passive investors as free riding. I don't mean this in a negative sense. I just mean it in a literal sense. On active investors who are keeping prices somewhere in the direction of reasonable. And if there are fewer of them, less people thinking about this, less people willing to take active positions on it, then it's pretty easy for me to believe deviations can get larger. The other thing I think happened, and here I'm going to sound like a very old man complaining about the kids. That is because in this case I'm a very old man complaining about the kids. So you're not mishearing. But I do think the environment, social media, trading on your phone 24/7. I don't know. I didn't ask when I was there if Israel has legalized sports betting.
Not so much.
But in the US we do now. And I'm convinced most people cannot distinguish their stock market trading app from their sports betting app. It's just this virtual activity. Our politics. Again, I'm going to comment on the US. If it applies to Israel, you tell me. But I don't find many people in my country who don't think our politics have deteriorated because of social media. Again, you could be on the left, you could be on the right. We all live in our own bubbles. Algorithms exist to make us more extreme about everything. Why the exact same thing would not be happening in stock markets, I couldn't tell you. Stock markets are subject to herding behavior. They're only efficient if we have the famous wisdom of crowds. Hopefully we've all heard that term. The wisdom of crowds says, yeah, all of us, myself included, might be pretty slow-witted. We might not know what's going on. But some of us do, and some of us have an inkling. And if the crowd is pretty independent of each other, all the random stuff many of us believe averages away, and the truth is kind of left in the average. That's only true if the whole crowd is relatively independent. If the crowd talks to each other, it may get the right answer and be a wise crowd, but it may become a dangerous mob. So I do think today's environment has led to some more extremes and some more mispricings. All of us, your original question was about AI. This is going to be the meanest, most arrogant thing I will say here. For the foreseeable future, again, on a long enough basis, yes, everyone's out of work, not just the quants. But for the foreseeable future, somebody thinking because they have an iPhone in their hand that has an app called AI trader, that's the same thing as actually people who've been doing it for 30 years. Not the same people. We do, hire new people over time. I think that makes us money. It probably makes me go crazy for the occasional year. Any active manager, quant or not, in the world is subject to this same hypocrisy. I will now tell you. Remember, we think we make our money because markets aren't perfect, and it's our job to take the other side when there's an error. And then we get nice and mad when those errors get bigger and cost us money in the short term. I promise you we do. We all do. The paradox is we wouldn't have a business and we'd have no social function if markets didn't occasionally go crazy or get worse. So managers like to complain about the markets and say, oh, they're always nuts, but they have nothing to do if they in a perfect market. So somebody thinking a tool in their pocket can cure all ills, even the AI. Let me make this as humbling for myself as possible. I don't have deep mathematical understanding of our AI models like I did our original factor models. Younger, smarter people than me have deeper understanding at AQR. Without a team that we've built over many years, I don't think I could be a very good trader with AI right now. AI is a bit of a nuclear weapon. It can overfit, meaning it's a very powerful tool for explaining what has happened, but overfitting has always been a worry in statistics and investing. Finding patterns that have occurred in the past but are simply random is very dangerous. For instance, if you test 100 things and all of them are just random, one of them after the fact is going to look 1 out of 100 great. So if AI has increased our ability to do that, it's both a stronger tool in our hands, but in some sense perhaps more dangerous. So if AI is going to make the individual investor so good, and here's where I'll link the two. What I talked about before with efficient markets and your AI question, the only way that gives us nothing to do is if it makes markets much closer to perfectly efficient. As long as there are inefficiencies and errors out there, we have to adapt our models, we have to build new models. They're not the same as they were a year ago, 5 years ago, and my God, 30 years ago. But unless markets get perfectly efficient, we got lots to do. And we're using AI like crazy to try to do this now. But if I retired from AQR, didn't have these teams, I don't think I would be trading AI on an app on my phone. And I have some experience in this. This sounds terribly obnoxious when you talk about the individual investor in a negative way. But of the many things I fear, the individual investor getting the tools and then acting rationally, which is the hard part, right? The tool is not always the hard part. That would make the market so efficient that we couldn't make money is not high on my worry list. Okay. So higher on my worry list is the individual investor going so crazy that even we can't take it. That has never happened to date. And I don't think that will happen, but I worry about that more than I worry about the individual investor being so rational and so tooled up that they take away all the opportunity.
Okay, so it's an opportunity rather than a threat, definitely in the medium term is what you're seeing.
Right. Absolutely.
Right. I think I have time for one more question, given that you really should be going to sleep, Cliff. I mean, you've really evidenced your experience working in finance at night during this very clear interview and your answers.
Well, I should tell you, my wife is up and listening, too. So she gets more credit than I do. I promised to be at this with you guys. Right. She didn't.
Thank you very much. So to a final question, I'm going to try and pull a couple of parts together. Recently, The Economist, last week, its top finance article was saying that passive investing, which you alluded to, is actually causing, it quoted research that passive investment is causing these elevated multiples. And we're really seeing investors feeling that they have to join the party with these elevated multiples. They've been elevated for so long, maybe it's a new normal because tech companies can run with lower capital ratios and make higher quality profits. And I think that's why, you may correct me on this, but the most entertaining research piece that I've read of yours over the last couple of months, titled 2035, An Allocator's Look Back Over the Last 10 Years. I think why you called it 2035 is because you think that things will play out over the next 10 years to prove that we're in this long-term bubble. So do you think we'll come back from a CAPE of 30 to 20? Are we in this long-term bubble? And I'd recommend this piece. If you go to the bottom of the invite, you'll see a link to Cliff's blog.
First, thank you for your comments on the piece. I will warn everyone, it is fairly tongue-in-cheek. Yeah. You do me a kindness saying I chose 2035 because I have some specific opinion that things will return to more normal. I chose 2035 for the same reason many other people use 10-year periods. It's short enough that you can say something relevant. I don't know what's going to happen over the next 100 years. And it's long enough that I can run away from the predictions if they don't come true. I think it had to be an economist, but somebody famous once said, if you make a forecast, tell them what, but don't tell them when, or tell them when, but don't tell them what. So there is a little bit of just, if I have certain opinions, this is the time frame I get at least somewhat confident about. But when you read this, there's a fake confidence. The idea is I'm in the future and looking back, so I'm discussing it as if it happened exactly the way I think. The question of elevated multiples, and you're right, CAPE is what we all talk about. I remember when Bob Shiller came up, along with John Campbell, came up with the CAPE back in 96. Again, for the fellow veterans in the room, the CAPE was what Shiller used in testimony to the Fed or to Congress, I forget, which led Alan Greenspan, I think in 96, it may have been 97, to use the phrase irrational exuberance going on, which sent the market way down because Bob Shiller convinced him the CAPE was very high, and that led to lower future expected returns. And Greenspan, who was then the head of the central bank, echoed it. And in typical central banker, I met with Amit Yaron when I was there. So Israel's central banker is much better than anything we've ever had in the US, so I'm not criticizing him. He and I were actually grad students together at the University of Chicago. So it was kind of a fun reunion. But when central bankers say something that sends the market down, the next day they say, we were only kidding. So Greenspan walked that back fairly quickly. But CAPE's been around a long time. It's certainly not a perfect measure. Trailing 10-year inflation-adjusted earnings. There's no magic to that. But there is a utility to us all talking about the same measure at least. At least we have a common thing to compare. And the global CAPE is quite high versus history. And the CAPE in the US stands out. The historical average price to cyclically adjusted earnings has been probably about 15, 16 over 120 years. Actually, with the last 20, 30 years averaged in, it's probably 17. In the dot-com bubble, it hit a high of about 45, so almost triple the average. It's currently, different people, believe it or not, I just said it's a simple measure we all agree on. We don't all come up with the exact same number. But most numbers I've seen are in the mid to high 30s. So we're not talking dot-com bubble, but we are talking quite high. Now, what I think is interesting is how we got here. If you look, and I'm going to mostly quote US returns, and it's not because I'm from the US. It's because it's half the world market, and it's the one that's the most extreme. The US has beaten an ex-US index over the last 30 years quite handily. I know you're professionals. I'm not telling you anything you don't know. But if you dig into why it has outperformed, and we have several papers on our website on this. One I wrote was called "The Long Run is Lying to You," meaning you can see something for even 30 or more years that is a one-time event, that isn't truth. You think you have a ton of data. You think 30 years, but you don't always have it. If you look at the last 30 years, about 80% of the US's outperformance has been expansion in the multiples we're talking about. So 30 years ago, the US sold for a lower multiple than the world. It now sells for a considerably higher multiple than the world. So in the absolute sense, or versus the world, multiple expansion has been a huge part of the very strong US stock market returns. Going forward, even if you think, by the way, 80%, this will be the only math in our presentation this morning, that does leave 20% left over. Wasn't the hardest math. The 20% left over is the US has actually had exceptional fundamental performance. Just looking at earnings growth is one way to do that, but you can look at revenues, you can look at anything you'd like. But that's a fifth of why the US has outperformed the world. 4/5 is getting more expensive. And again, I mean this in the paper, in the 2035 paper, I talk about both absolute returns and the US against the world. Even if you're a believer that the exceptional fundamental performance in the last 30 years is going to repeat, I think it is absolutely crazy to assume the 80% of what happened, the multiple expansion, will happen again from here. This would mean capes of 100, not the 45 of the dot-com bubble. So in the piece, because I'm trying to be amusing, there's mean reversion in the cape. Meaning, I say we came back to a more historically normal, just like you asked about, cape. I have to admit, in our actual, we put out forecasts. We put out 10-year expected returns. By the way, we don't trade on these. We do this because Antti Ilmanen, I've known Antti for about 40 years, and I still mangle his name occasionally, particularly at 4:15 a.m. And I want to say, I'm proud of nailing it there.
Well done, Chris.
But some of you have probably seen his books. One is Expected Returns. One is about a lower return environment going forward. He's one of the world gurus on long-term stock returns. I would say Elroy Dimson in the UK, who Antti has written with, is another one. Antti does our forecasts, and we do them because our clients appreciate them, and we like to make our clients happy. Again, we don't trade we don't just short the US stock market because the cape is high. But we do think when it comes to making a long-term forecast, even if it's going to be wrong sometimes, when you're paying more for the cash flows, it's rational to forecast a lower than normal return. And Antti's official forecasts really don't even assume mean reversion. they do assume kind of a steady state, which would be a new normal, to use your phrase, which I think was a PIMCO phrase many years ago. And now we all use that. I think it was Muhammad Al-Arian's. Even if we're at a new normal, you still make less if you pay more for the cash flows than you used to. You can think of it as a bond. If a bond is yielding less than it used to, it doesn't have to collapse to make less going forward. You make the new yield. So the piece is fun. I had fun writing it, but it is more extreme than our forecasts. And you might ask why we make forecasts we don't trade on. Well, I already told you one is our clients seem to appreciate them and we find it intellectually interesting. But why don't we trade on it? We don't trade on it because a 10-year forecast of lower than normal returns is somewhat useless to a trader. Because often that forecast, and Anti's forecast today, are not for negative returns over 10 years. They're just for less than we've gotten used to. Even if you believe Anti is 100% right, and of course I worship at the altar of Anti on these things, even if you assume that, underweighting or shorting an asset that goes up just less than it normally goes up means at the end of 10 years, if you still have any clients at the end of 10 years, you get to tell them, the bad news is I lost you money for a decade. The good news is I lost you less than I would have over the prior 100 years had I done the same thing. And I have some experience with investment returns in clients. That does not sound like a great story for them. And it is what we think is accurate. We think you can use these numbers to say the odds are for lower returns than normal, but it is not an active management trading model. Use valuation alone for that at your own peril.
Thank you very much, Cliff. Thank you for that answer and all the answers and sharing with us that background.
I'm happy to.
I'd like to wish you a good night's sleep. I'd like to welcome you back to Israel. We're looking forward to seeing you for AQR. And very much a message to share on the personal side, not AQR related, is welcome back as well. You haven't seen Tel Aviv region in depth yet. And really to thank you, and it's hard to overstate, how important and how much it means to people in Israel when leading figures like you have gone on public record and written what you have so clearly about the situation over the last 2.5 years. So thank you.
I've written a few things, and I do a lot of pro-Israel ranting on Twitter.
Yeah, thank you very much. Good evening.
But I haven't fixed the problem yet. I'm still working on it.
All being well. All being well.
Thank you all. This was a lot of fun.
Thank you.
Have a great day.
Thank you, Cliff. Have a good